Let's get into part 2 about why this stock market keeps going higher. It seems like you guys like the first part, which you can go back and watch this video where it looks like I'm about to sneeze, but you would never catch me sneezing on camera because that is unprofessional. So part 1, just to recap, what was the main thing we were talking about that moves markets? It is supply and demand. So in the last video, we explained how the demand is huge for US safe assets. And US safe assets, again, are treasuries. So a lot of the demand is coming from overseas, where all these countries, they're developing super fast, their GDP is exploding, but their financial systems are lagging behind that growth. So there's not a lot of places to put all this money that's being made. So all these people are putting that money into the US. So huge demand, right? And then the supply in the US of the US treasuries, they keep issuing more and more, but it's not enough to meet the demand. So bond prices are getting pushed up because there's too much demand for a little bit of supply. And that means interest rates are being kept low. And when interest rates are low in bonds, then people look to the stock market to get returns. Because stocks and bonds go like this. Wherever there's a higher return is where money's gonna go. So because bond prices have gone up, interest rates are low, there's a low return because of that low interest rate. All that money goes to stocks, where people think they're gonna get a better return. That's the quick summary of this video, but go back and watch this if you need to. Now in this current video, we're gonna talk about more specifically what's happening to the US stock market. And again, it relates back to supply and demand, as you'll see. But before we get into it, remember that the price action masterclass is open right now. So as I've already said, this video explains why the bull market is gonna keep going. And if you wanna make sure that you're taking full advantage of that, then you need to make sure that you're using price action. And the best way to make sure that you're using it the right way is with this masterclass. Surely you will ensure that you have the right skills to ensure your returns in the market. Surely. Sure. Just in case I didn't say sure enough. There's a 60-day money back guarantee on this thing too. And it's only open until Sunday, so click the link down below in the description and comments to check it out. But okay, let's look at the supply and demand imbalance in the equity market. So if we think about demand, where is demand coming from equities? Well, most of it comes from people's savings, the amount of money that they have available to invest. So this fluctuates according to levels of cash and credit in the system. And credit is super easier to create in an economy. It's created like any time two people agree to an IOU. So if someone gives you something and you say you'll pay them back later, that's credit created right there. Much easier than cash. So that's why credit largely drives the amount of investable money in the system. And what do we know about the economy right now? Low interest rates, right? Low interest rates means high liquidity, because a lot of credit can be created when creating credit is cheap. Because again, if interest rate is low, you don't have to pay that much for it in the future. And if it's cheap, more is going to get created, so there's more money in the economy. And again, when we're talking about savings, we're talking about all of that money, and we consider it all available to invest. So there's your demand right there for stocks. All this money floating around. Now let's look at the supply side. And on the supply side, we got to think about how many shares of companies are actually available on the market. Well, what's interesting is that over the last 3.5 decades, corporates have been reducing their share count through buybacks and M&A at an average annual rate of 2%. So the way it works is that a company has a number of outstanding shares in the market that you can buy, right? Well, there has been a huge trend of corporate buybacks, where if they have extra profits, what they're doing is buying back their own shares. Now, the reason they do that, well, that can be a whole nother video explaining all the reasons. But a big one is, once again, if there's a lot of money in the economy, when there's a lot of money in the economy and everyone is cash flush, then what do you do with that money? Whether you're a corporation or an individual person, you end up investing it and buying shares of companies. But as a corporation, they buy their own shares. And one theory says that they're just buying back their own shares because they can't find an actual productive use for that capital. And when you think about all the management in the company, when their performance is tied to the stock price and they all have options, well, if they buy up their own shares with company funds, then they're just pushing the prices up of the stock that they own, really benefiting themselves. So those are just a few of the reasons why we've seen this big trend of share counts going lower through buybacks. And then of course, once again, because there's so much money floating around, there's been a lot of mergers and acquisitions. Got a bunch of cash, go buy another company. It's the best time to do it right now. So these things together have made the actual amount of shares available decline by 2% each year. So the number of shares available to trade and buy and invest in has been steadily falling, while at the same time, as we explained before, the amount of money, the cash and credit, has been steadily increasing. So now what we're about to show you is the crazy math about how this works out. So in the last 50 years, the money stock in the US has gone up at an average annual rate of 8% a year. And again, money stock is the total amount of money in the economy. And over the last 5 decades, the supply of equity, which is the available shares in the stock market, has been dropping at an average rate of 1 to 2% a year, which is at the same time as this 8% a year growth in money. So 8% is the demand, and the supply is shrinking by 1 to 2%. So if you look at the difference between this growth and this shrinkage, what do you get? Approximately 9.5%. And that's what it's saying right right here that we get a structural deficit of that every year. And you want to guess what the average annual return of the stock market has been over the same period? It's been 9.5%. That's the average annual return of the S&P 500 over the last 50 years. And as we just explained, it's the average yearly deficit of equity supply in our stock market supply and demand model. So really, it's just math. So if we keep everything else constant, then the market value of stocks have to rise at the same level of the supply and demand mismatch caused by the share reduction in money creation, 9.5% a year. And there you have it. You have straight up math explaining why the stock market keeps going up. Less and less shares with more and more money, tons of demand and little supply. What's going to happen to the price of each one of these shares? They're going to go up because all this money is bidding for them. Same thing as in the last video when we were talking about the government bonds. Short supply of the bonds, lots of demand, those prices are going to stay up. And just like that scenario wasn't reversing anytime soon with the bonds, this whole stock scenario is going to stay in place for a long time too. So to sum it up, over time, the market has to rise because we operate in an inflationary system. This is where the quantity of money is always going up. And the corporate sector, because they love buying back their stock, that keeps share growth negative. Supply dwindling with demand increasing. That's why the stock market keeps rising. And once again, if you want to take advantage of this bull market, then make sure you got this price action masterclass. Closes Sunday. It's a 6.5 hour class. This is going to teach you everything we've learned in our team's years of doing this. Whether you're a beginner, advanced, it doesn't matter. You're going to learn something. And if you don't, that's fine because there's a 60-day money back guarantee. So just email us and we'll give you your money back. So there really is no risk to check it out. Do that and take advantage of this bull market that we're in. Price action is going to help you a lot with your returns. If you like this video, make sure you smash that like button and then leave any comments or questions you have down below. I just want to make content that you guys want to see, so let me know. And then, of course, subscribe to the channel so you can see that future content and hit that notification bell so you get email notifications when that content comes out. Subscribe and I'll see you in the next video. Stay fallible out there. Bye.